Hello and welcome everybody. Welcome to November and welcome back to Sectors Made Simple. I'm very happy to be here with you all today to talk about a little bit of review of October. Now, we've talked quite a bit back in October about the importance of this month and why it was so pivotal for where we are in the market right now. I don't think you need me to tell you we are in a bear market, and October has a reputation of being a bear killer. So many of us went into it very optimistic that this is going to be the beginning of an uptrend and we're going to see positive gains throughout the month and everything's going to be great. Right? Well, today we'll answer that. We'll look at what changed last month in October. We'll look at what's happened so far in November because it is not November 1st. Today is November 4th, and we've already had one of the largest, if not the largest, event in November happen on Tuesday and Wednesday, November 1st and 2nd. So I want to review that with you all and talk about what is coming up for us within the next few weeks through Thanksgiving and a little bit more. So welcome back to Sectors Made Simple. We're going to take a look at sector rotation and sectors throughout October and give our forecast for where things might be headed in November. Before we do, about 30 seconds of news really quick. For all of our Sectors Made Simple subscribers, we started a new class series this past week. I wouldn't call it a class series, a webinar series this past week in which my mom, Julie Stav, and Melly Ines have been trading live 2 hours on Tuesday. So first 2 hours of the market on Tuesday and last 2 hours of the market on Thursday. These classes will be continuing for all of November and December 1st. So if you're interested in getting to see live options trading and learn from the best, head on over to sectorsmadesimple.com. Any subscription will give you access to those classes, so now's a great time to get involved. Not only that, we also are working on finalizing the sector, or rather the S&P 500 stock screener. This screener is going to give you lots of features that you love about a stock screener, such as chart signals and a little bit of Sectors Made Simple flair with relative strength. We've created relative strength for the S&P 500, and coming this month, we will be giving those tools straight to you to learn how to use to invest simpler. So, live options trading webinars and brand new S&P 500 screener, all included with the Sectors Made Simple subscription. All right, promotional stuff over. Let's get into the content for today, shall we? So, let's talk November market forecast and October market review. Disclaimer, everything I'm talking about today is my own research and my own opinions of what that research has showed. Please take it as my opinion, not as complete fact. Again, the only certainty in the market is no one is certain. So, when I say something, don't think that I'm promising returns, or don't think that what I'm saying is what is going to happen. I don't have a crystal ball, and if I did, I'd be playing the lotto right now. What is it, $1.4 billion? Something crazy. But I don't have a crystal ball. I'm not playing in that lottery, and past results can never guarantee future performance. Please do your own research. Consider this a piece of your research, but always trust but verify as well. All right, the goals for today's webinar. We're going to look at what changed in October, because October was a very, very important milestone for the market and a very important potential turning point. Since World War II, October has been a bear killer, seeing the end of bear markets and the beginning of bull markets for 12 bear markets in the past. So, will October 2022 be the bear killer once again, making 13 bear markets and the beginning of a positive trend for the market? Or does the market continue its downtrend that we've been seeing since August? And additionally, when we're talking bear killer, we're talking about the S&P 500. But by the YouTube name down below, Sectors Made Simple, also while you're looking at our name, there's a subscribe button right here. If you haven't clicked it already, please do. It's totally free. It really does help us out. So hit that. We really appreciate it. Anyway, I said I was done with the promotion stuff. Sorry. Sector rotation is at the forefront of much of what we look at here at Sectors Made Simple, so we will be looking at sector rotation changes in October and talking about where those rotations might be taking us in November. As well as we'll be sharing some notable dates and periods within November to keep your eyes on. So, all of these answers and more coming in today's webinar. First, let's start off with a little bit of background context. Before we even get to the October review, let's go even further back. September. September did not leave the market in very good shape. We saw the majority of sector ETFs and the S&P 500 ETF SPY all in sell signals. Over 2/3 of companies in all of these sectors were on sell signals, so all of our bullish percent indices were in downward trends and well below 30%, and extremely low investor confidence. Now, October was the very hopeful dream of October has broken 12 bear markets. Will 2022 be number 13? Well, a lot of October, while we could say that yes, October has historical positive trends, and we'll talk about those later, a lot of October's strength this year and potential for growth relied on positive economic data, so inflation going down and also earnings performing well for companies. But did that actually happen? Well, let's see. What I'm going to show you next is probabilities. Probabilities are the chance out of 100% that something happens. So when we're talking about probabilities, what we are looking at here is what is the chances of the market going up that day or down that day. It does not care by what percent. All it cares is it went up or it went down. Then we will compare that day to October of this year for that day. And we'll look at when we saw a surprise. So a surprise could be a good surprise or a bad surprise. It could be your family showing up for your birthday or your family showing up unexpected. Might be a surprise, a good surprise either way, but I move on. What we're looking at for surprises here is when the probability said this is the most likely thing to happen, but this happened instead. So it could be the market said, the probability says it's more likely that it goes down. And if it went up, that would be a surprise. It doesn't matter if it was a good surprise or a bad surprise, it's a surprise nonetheless. So with that said, here is what that data shows. We see that things were pretty evenly split. We had a total of two more surprises. Actually, we're even. We're completely even throughout the month. So things were neither a surprise nor expected. But what we did see was a couple of good days, a whole lot of bad days, and then a little bit of bumpy road from there on out. This does not tell the whole story, though. If we only look at the S&P 500, we lose a lot of the detail of what happened, because what actually happened isn't shown right here. We just have to look a little bit closer and look at sectors. With that said, I want to break up October into two main parts. The first half, which is everything you see on the left side. So the 1st through the 16th, if we only looked at days that the market was open, the 3rd through the 14th. On the other side of the chart, we're going to be looking at everything that happened after that. So the 17th through the 31st. So first half of October is what's on the left. Second half of October is what's on the right. Here is the sector returns through the first half of October. Utilities and real estate got clobbered. Energy was one of two sectors that saw positive gains, energy gaining 5.5%. And the closest second sector, the only other sector to see positive returns, healthcare, at a whopping 0.25 or 0.24. I won't round. That is lackluster to say the least. Somewhere in the middle of all of that, between the near 8% losses and the near 5.5% gain for energy, we have everyone else. Defensive sectors, such as staples, kind of held on, while more sensitive sectors, such as technology and discretionary, saw more sizable losses. But the majority of sectors saw losses in the ranges of about -1% to 5%, with the outliers being energy at 5.5% positive return, utilities and real estate around that 7.8 to 7.9% loss. All of that results in SPY, the S&P 500 ETF, losing 2.6% in the first 2 weeks. That is a little bit worse than what we had expected it to be. Now, what was going on in the first half? What led to this kind of slow meltdown of many sectors? Well, it's not so much that there was one big event that caused it. More so, the data that was coming out wasn't giving us any good news. In last month's forecast, I mentioned that right now we need some good news. We need good economic data to say that the economy is moving in the right direction. And the market will be shaped by that economic data. The first 2 weeks of the market really showed that. We did not get any good economic data. In fact, the main piece of information that we got was the October 13th announcement of the September PCI inflation numbers. Oh, that's wrong. That should be CPI inflation. What happened was on that day, SPY reached a new 1-year low, 52-week low of $348.11. And then immediately after, skyrocketed, up 5% on the day. Now, what happened? If you notice, I didn't say what the CPI inflation number changes were. And that's intentional. Because if you only looked at the market reaction, you would have thought it's great. It's up 5%. Unfortunately, while we did see a decrease in inflation, headline inflation, the decrease was 0.1%. To give you an idea, we are seeing federal fund rate changes of 0.75% every meeting. 0.1% inflation is, yes, it's a decrease. It's not an increase, but that's the glass half full way of looking at it. The glass half empty or the glass is just almost empty way of looking at it, we are making way too big of changes in the economy to only see a 0.1% decrease. So the following day, the market did make some corrections. But then the market got optimistic. And the reason for that is, again, it's hard to point it to one thing, but earnings is probably one of the biggest impacts. But in the first half of the month, we saw SPY have an average gain of 0.2%, with 6 days being surprises. 2/3 of those days, or 4 total, were negative days. Now, the second half of October, again, we just said how the CPI inflation numbers were not good news for the market. How did the second half of October fare? Well, interestingly, it's where things started to get better. Again, we needed some good news. And while the inflation numbers wasn't the good news that we were expecting it to be, earnings season began and gave us that good news that we were hoping for. SPY saw a daily average return of over double what it had the first half of the month, with an average return of, hi, good job. Our cat Cleo has a little toy that she loves bringing up and down stairs, and she sings a triumphant little song when she brings it down. So I had to acknowledge her. Praise the cat. Anyway, the daily average return for the second half of October doubled up to 0.47%, so almost half of a percent per day. But the real story was not in SPY, it was in the sector ETFs once again. That's where the big story really happened. Now, with that said, let's look at how sectors fared throughout the same period. It was not the one-sided story that we saw in the first half. Everyone, except for communications, we'll talk about communications in a minute, saw very solid gains. Discretionary had some hiccups. Major earnings are a big portion of that, and Tesla is a big portion of that. But the remainder of sectors saw very sizable gains, ranging from 10.7% in the case of energy to around 4.85 to 5%. That's a really strong 2 weeks in the market, and it's a massive shift from the very bumpy start that we had. This looks a lot more like what we were hoping for this is what we were hoping for from October. We were hoping for this to happen. Market-wide gains and recoveries. We've looked at the first half. We've looked at the second half. Let's smash it all together and add in some probabilities as well. This chart shows those probabilities. On the left side, what you see is the probability of, for each one of these ETFs, that ETF saw positive gains for the month of October. So if it says 75%, 3 out of the past 4 years, we've seen positive returns for that sector. Then the average return is the percent change, the average percent change for that period. Over the past 10 years, the majority of sectors saw gains in October, with returns ranging from 1 to 3%, except for energy. Now, looking at the last 4 years, things middle out a little bit more as far as probabilities go, and actually turn fairly negative, with only 4 sectors actually seeing positive returns in October, despite October's history of being a bear killer. So did October lose its steam, or did something else happen? Well, it's too difficult to tell, and it's impossible, honestly, to be able to definitively say. If we look just past that, and we look at what happened this year, which is the far right column in the 2022 returns, we see a very, very, very one-sided story. And that story is very positive. Sectors saw positive returns ranging from about 5% up to 20%. Now, there were some sectors that saw minimal change in real estate, utilities, and to a small degree, discretionary. So we are seeing some positive returns. And by positive, I mean very positive in the case of certain sectors. Now, a lot of this might be due to earnings. So what actually changed? What changed is that, well, we can't really just point to a single thing. So here's just the things that I've found or that I've discovered through preparing for this webinar and just daily research. It's very fascinating for me to get to follow these changes happening in real time. So this is what I found. The market was worried about earnings. Now, earnings are not just a singular thing. It's not we know nothing and now we know everything. Earnings are a gradual discovery process. We get more and more information as the quarter comes closer, and then we get even more information as they start to kind of prepare for their earnings calls, and then earnings aren't even the end of the story. Earnings oftentimes lead into GDP, gross domestic production, which October also saw the release of the first estimates for quarter 3 2022 GDP. So earnings are not a singular moment that changes the market. But earnings, we gain more information as earnings calls get closer, and earnings calls help us get closer to understanding GDP. Now, I won't get into it very much in this webinar. I covered it a lot in Tuesday's market review that I did with Sectors Made Simple subscribers. But just to quickly summarize, earnings are a one-sided thing right now. What we're seeing is a large difference between the earnings of most companies and earnings of energy. So if you only look at entire S&P 500 wide earnings and try and say what's the average return, what's the average revenue, what's the averages here, you're not going to get the whole story. In fact, you're going to actually see the opposite of what's really happening for companies outside of a single sector. Energy. So energy is not only leading the market, but is also completely skewing the way that we look at earnings. The earnings for that sector are actually just that crazy. But that's not the whole story. Because if that was the whole story, we wouldn't see this happening. This is market-wide recovery, not a single sector pretending that everything is okay. So what gives? I thought that earnings for other companies weren't that good. In fact, they were negative. The average earnings, excluding energy, is negative. Well, it is negative, but this is just the start of the good period for many, many, many sectors and industries. Historically, many bullish trends have begun in October. That is why it has a reputation as a bear killer. It is a seasonal bullish period. Seasonal means every year it's going to likely happen that these certain sectors and industries perform very well. And right now, we need that. And that's kind of what we're seeing. In addition to strong earnings, we also, or not strong earnings, but in fact, better than expected earnings. We have to remember that the market has an idea of where they think earnings are going to be. And investors bet on which side of the earnings they think we're going to be on. Beat estimates or fall short of estimates. When we find sectors and companies outperforming earnings estimates, that's a good thing. So even though some of these earning estimates were probably negative, if the estimate is negative and they outperform it, even though the earnings still might be negative, it's better than was expected. And investor confidence kind of backs that theory. We've seen an increase. This is not an actual percent out of 100% increase. This is compared to September 29th increase of 32.5% in investor confidence. That is a massive, massive increase. And again, August was among the highest we've seen for the entire year for investor confidence. September, the end of September was among the lowest. So this is a very positive step back towards building investor confidence. So all of this worked together to make this earnings season extremely rewarding for companies that performed well. Back when quarter 2 earnings were a discussion, we looked at earnings in a little bit more detail, and in that webinar we found that earnings for quarter 2 was rewarding companies that performed very well, quite nicely, but was not punishing companies that fell short of earnings estimates. Quarter 3 has been a little bit more realistic. Quarter 3 It has not been everyone gets off for free and those that did really well get a gold star. The gold stars are still being handed out. We did see that compared to the 5-year average between the before the 3 days, 3 days before to 3 days after, the percent change between those two dates, we have seen over double the 5-year average for companies that have beat earnings estimates. That means that we're rewarding companies that are doing well right now, or are doing better than we expected. Except for one. There is one sector that stood out as the problem child. Communications. To say communications got hit hard in October is an understatement. Communications got destroyed because of two companies' earnings in particular, Google and Meta. These two companies make up a very large percent of communications' overall value. And more than that, both of these companies rely on two main things to be the drivers of their stock price. Growth valuations, meaning that they are not considered to be a value company. They are not well established and are going to be around for decades longer. They are companies that rely on rapid growth and continual growth, and their value as a stock is shown in that. So when we're looking at a company that is worth a lot because of what people think it could be worth in the future, when we don't get numbers that match up with our expectations, the value is in what other people are willing to pay for it and what we think it's going to be worth in the future. The minute one, the other, or both of those things start to fall apart, the stock price is going to tumble. And the biggest thing that I can point to as the reason that both of these companies got clobbered in earnings was that they rely not only on growth valuations, but on ad revenue to create that growth valuation. They rely on companies investing in ads and spending money on ads on their platforms. And for both of these companies, compared to the previous year, ad revenue has been down. Not by much, but down. As a result, between their earnings call and the end of October, Google saw a loss of almost 14%. Meta doubled that with a loss of 27.8%. Of course, when these are the two largest holdings in XLC, we will see XLC take a large hit as well. Now, does this mean that both of these companies are down, out, and on their way through the door? No. These are still among the largest companies in the entire world, definitely some of the largest in the US, and are still prevalent. These are still very, very strong valued companies. But this earnings season was a little bit of a reality check for where we value those companies and how much we value those companies. I'll take a little bit more of a look at this when we come to our earnings webinar, which we'll have in the next couple of weeks, once earnings season's a little bit more wrapped up. But now let's turn our focus back towards where we finished off with October. Because October, we got a little bit more information towards the end of the month. That was actually positive news. We've so far only talked about not great news and kind of middling news. Let's now talk about some good news. The good news is that October ended with the reveal of the Q3 2022 GDP estimate. This is the first of 3 publications that we'll get, but the first one nonetheless. It was many consumers and investors' first look at how the US economy has changed in Q3. This announcement saw a 2.6% increase in year-over-year GDP. Now, this is important. This is big, because this was a very positive indicator that we're seeing market and economic recovery. GDP, if you had to ask many, what is the one thing, if you can only look at one number to say the health of the economy, what number would it be? Some might say inflation, some might say unemployment rate, some might say, honestly, most will probably say GDP. GDP is one of the historical definitions of a recession, being two periods of GDP losses, two consecutive periods of GDP losses. So seeing a 2.6% increase was a very positive boon for the market. But this would last only a couple of hours, because the next day, actually not the next day, the next week, the 1st and 2nd of November, we had the FOMC meeting. And that is where we can kick off our conversation about November. Kind of funny how we're doing a November market forecast and reviewing the first couple days of November. That's just how the calendar worked out. But November so far is shaping up interesting. The first thing and the largest thing that we should talk about is the FOMC meeting from Tuesday and Wednesday, November 1st and 2nd. In this meeting, I apologize for the wall of text, the Fed announced that they were making a change to the federal funds rate, and this change was larger than many analysts and banks expected, increasing the federal funds rate another 0.75%. But while that was not shocking news in of itself, Jerome Powell had a press conference after they made this announcement, in which he stated that the Fed's estimates from September of where they see the inflation rate and where they see the federal funds rate going are likely too low, and we'll probably see larger changes beyond what those summary of economic projections from September were showing. And Jerome Powell stated that the Fed will continue to aggressively make changes to the federal funds rate and other monetary policy tools until inflation is brought back down to their 2 to 3% target level. There's a lot of room that is going to need to be made up, and the dream of a soft landing, this very easy approach back towards a low inflation rate, gets slimmer and slimmer. The further into this we go, the higher the interest rate ends up, and the more resilient the economy and inflation is to actually seeing this change happen. Now, the market unsurprisingly did not react well to this announcement, or, to use the economic term here, the hawkish speech, indicating that it was not a positive speech, it was a very conservative and very concerned almost speech. We saw in the last last hour and a half actually, in the market, the SPY dropped by 3.4% by the end of the day, dropping another 1% at market open the following day on Thursday. So is that it? Does that mean that all of October's momentum was lost in a single afternoon? We worked very hard. Not actually physically worked, but there was a lot of ground for us to make up in October, and for many investors, there was not only the actual profits as a result of what was happening with sectors, but also sentiment, an improvement in atmosphere and how investors are feeling about the state of the market. Did all of that get erased this past week? The answer is going to depend on who you ask. In fact, I'm curious. If you're here in the chat right now, what do you think? Do you think that the momentum that we gained in October was lost in the first week of November as a result of the FOMC's announcements? To give you my opinion, and I guess it's already there, so it's not a surprise, no. I don't think so. Was it a blow to investor confidence? Yes. But 0.75 is not the first. This is not the first time we've seen 0.75% this year. It is a large jump, but it is not shooting way past the summary of economic projections from September. And again, this is economic policy. There is a slight difference between market atmosphere and market environment and economic policy. So if you asked me, my opinion is no. I don't think it's going to completely derail the progress that was made in October. And if you ask many investors, and by many investors here, I'm going to be looking at the bullish sentiment survey that is published, their opinion is also no. If we looked at the US investor sentiment, which is a gauge of 0 to 100% of what percent of investors are feeling bullish or bearish about the state of the market and the future of the market, we actually saw an increase from before the FOMC's announcement on 10/27 and after the announcement when we got the new data yesterday on the 3rd of November. That increase was 4%. Is that substantial? No. But it's not a loss, and it is continued positive movement. I actually want to pull up the chart with you all. It's fairly interesting data. So here's the chart as it's been for the past year. As I was mentioning before, in October, we saw an increase in investor confidence from 20% up to 26.6%. In the last week, we have seen that confidence rise once again, up 4% to 30.56. So is that saying that the market is saying bullish? No. In fact, if you just said you don't think that, if you think that this FOMC announcement is going to cause a shift in current direction of the market, if you said yes, 2/3 of the market agree with you. 2/3 of investors agree with you. What chart was that? It is Y charts, is the chart that I use to actually look at the data, but the data is published by the AAII, which is right here. So that is the data that I was using for this. So actually, the AAII page shows even more data for this, because they don't just show bullish versus bearish. They show the people that are fairly neutral. In the past week, we have actually seen a decrease in the number of people that are bearish, an increase in the number of people that are bullish, and a sharp increase in the number of people who are neutral about the state of the market. So if you said what's going on right now just derailed the market, 32% of the AAII investors agree with you. If you're not sure what to think, which is honestly the camp that I probably fall into, I'm kind of the see and watch and find out kind of person, neutral. And for the people that think we're only going up from here, 30.6%. So it is very well split, almost 1-1-1 between what people think the current direction of the market is. But the FOMC announcement, despite it not being what investors wanted, honestly, despite it not being anything that anyone wanted, it's not doom and gloom. It is not some horrible revelation that we are now struggling through. I hope, and I'm honestly thinking, that we will continue to see sectors move forwards in a positive direction, and November's forecast kind of supports that. So let's talk about November's forecast. In November, we're going to have a number of key dates, and they are out of order because PowerPoint can be difficult sometimes. Now, again, we don't have dozens of dates for us to keep an eye on. In fact, some of the most important milestones in this month are going to just be periods, not a single day. So, kicking things off here, starting off with next week, it is going to be the last major week of Q3 earnings, where we will see over 1,400 companies issue their earnings calls. November 8th, which is Tuesday, is going to be midterm election day here in the United States. November 23rd through the 25th is the day before Thanksgiving, Thanksgiving itself, and then Black Friday. Then November 30th is going to be the GDP estimate, second round of the GDP estimates, and the first issuing of corporate profits for Q3. With that said, let's talk about each one of these periods or dates and talk about why they've made it on this list and why you should care. The last major week of earnings. It's no surprise that the market is made or broken by earnings, and this year and this quarter is even more impactful than in previous years. The reason is that for the first half of the S&P 500 earnings, which is the data that I used in Tuesday's webinar and also this webinar, companies that had earnings above estimates were rewarded over 2 times the 5-year average. Now, companies that didn't meet estimates saw losses around the average, so the average is 2%. We saw companies that didn't meet estimates seeing losses of 2.2%. This, again, will continue to shape the market because we are seeing positive swings of 2% or losses of 2% on average when companies issue their earnings calls. As a result, those earnings matter. 2% is not a drop in the bucket when it comes to a stock's price. So these are very much events that are shaping a stock's current price and prospective price in the near future. So especially going into a week that we have the most earnings out of any single week for Q3 earnings, something to pay attention to. On Tuesday, we will also have midterm election day. Now, while S&P 500 and NASDAQ are not as affected by election day, the Dow surprisingly performs very well the day before and on election days. Now, while these days do see an uptick for the Dow, and again, minimal change for SPY and NASDAQ, Wednesday is brutal. Wednesday is one of the worst days of the month for the probability of positive returns. So while the first 2 days are very valuable and are opportunities, Wednesday kind of dashes those opportunities quite a bit. Now, this year's election day, again, everything that I just mentioned was historical. Historical days that are midterm or presidential election years. This year's election, personal opinion here, is going to be much more impactful. I think we are going to see a lot more action happen, not the day of the election, but the day after. Many voters and many investors feel that this election, this midterm election, is extremely important, as there are a number of very major and very divisive issues and platforms that are currently being discussed. The outcome of those major policies is very much reliant on what happens with midterm elections. And the market 110% will be reacting to wherever this line falls. I'll say this later, but I'll also say this again. The only thing that is certain about this election day is uncertainty. And the market does not like uncertainty. Let's go to something brighter and talk about Turkey Day. While the market is closed on Thanksgiving, the market sure gets in the holiday spirit. And I don't mean it's that one person in your family that starts playing Mariah Carey, All I Want for Christmas Is You, the day after Thanksgiving. We all know that person. You might be that person. But the market does get in the holiday spirit as well, but in the holiday spirit of spending and Thanksgivingness. The day before Thanksgiving and the day after Thanksgiving are extremely historically positive days for the market. All three major indices see returns or probability of positive returns in the range of 60% to 70%. The day before and the day after Thanksgiving, with some of this momentum even carrying through to Monday and Tuesday of the following week. Moving right along to the last thing for us to discuss in our forward look at important dates, Q3 GDP and corporate profits. I felt like there was enough going on next week that I didn't really want to mention this, but next week we will get the CPI inflation numbers for October of 2022, but I think that the other news, earnings, and midterm election day are going to be way more impactful for the stock prices that week. But if we're on the topic of economic data, we are getting those inflation numbers on November 10th. On November 30th, we'll get even more data, where we will receive the Q3 GDP estimate round 2 and the first corporate profit estimates as well. These two values are released at the same time and are very, very key talking points for economists and anyone that is trying to monitor what's happening with the US economy. Because many of us are still asking the question, are we entering a recession or are we already in a recession? Now, inflation has not started to really dip down to a measurable degree. 0.1%, again, is way under what it really should be given the amount of changes. Now, consumer spending is going up, positive sign, but corporate profits are also extremely high, or at least what we believe to be corporate profits are extremely high. This report is going to be very valuable because right now, it has almost become a political issue of, are corporate profits too high? This will provide some more data, ignoring the political side of things. It will provide more data for people to make a more informed decision of, is the problem that inflation is too high? Or is the problem that corporations are just making too much money and keeping those profits for themselves? It's very hard to know, but again, this data will give us a better piece of information to base our opinions on. With all of that said, I want to go back and just like we looked at the differences between October's predictions and reality, I want to do the same predictions for November. So let's go and look at the daily probabilities for November for the different major indices to see if there's periods of strength and weaknesses. And again, my PowerPoint is not playing nicely today. So on this chart, what we find is the first week already passed, but is historically very positive, around 60% average. Election week gets a little bit bumpy for everything that is not the Russell. And then the week after, just about everyone gets clobbered. Tuesday is okay, but the remainder of the week is not very positive for the market. Now, there are some major options expirations that will be happening on Friday the 18th, but those are overshadowed by everything else that's going to be going on post-election day. Again, we get in the turkey spirit a day early for the market, where we see universal 60% or higher probabilities the day before Thanksgiving and the day after Thanksgiving as well. And some of that bleeds over into the beginning of the following week, the last week in November. So, to summarize all of that chart, election week will see the Dow and Russell perform pretty well before and on election day, while SPY and NASDAQ kind of middle out around that 50% mark. The week after is by far the weakest week of the month, weakest week. And to kind of bring things back into a more holiday spirit towards the end of the month, we do see that the day before Thanksgiving and after Thanksgiving are a bright light at the end of the tunnel and the end of the month, as all indices enjoy very high probabilities of positive returns. Let's now move on to sectors and take a look at sector probabilities as well to see if we can gain any more information if we break down these probabilities into probabilities for each individual sector. If we do that, what we end up getting is something like this. Anything that is green for column B or D is going to be a over 50% probability of positive returns. The average return is the average return. And what we see is for the past 5 years, every single sector and SPY have had an average positive return. Not only that, only two sectors actually, utilities and communications, fall below that 1% line, with the majority of sectors seeing 2 to 4% positive returns, and in the case of energy, who's already been performing extremely well, 5%. Now, I want to give a little bit more context than just sector probabilities for this. But before I do, let's just summarize what we just looked at. There are many bullish trends historically that have begun in October. Those above 0% 5-year and 10-year averages kind of back that up, that these trends have started and are already in full swing come November. In the last 5 years, the average probability of a sector seeing profits in November is 62%, with an average return of 2.6% on the month. Now, while this is interesting in of itself, it's even more interesting when we pair it with sectors made simple data from the relative strength matrix. What the matrix shows is something really interesting. If we order, for those 5-year returns we just looked at, if we order the 4 highest returns from highest to lowest, we would have energy, industrials, materials, and financials in that order. If we go to the current relative strength matrix, which I'm going to pull up for us right now, I'm just waiting for the login. If we look at the current matrix and we sort by overall relative strength, again, those 4 sectors in terms of the average return over the last 5 years in order: energy, industrials, materials, financials. The 4 strongest overall sectors right now: energy, industrials, materials, financials. Or if we put them in order: energy, industrials, financials, materials. Interesting, right? So what we're finding is right now, going into November, the sectors that have historically performed the best throughout October are the current sector leaders moving through the beginning of, October. The strongest 4 returning sectors historically for November are also the 4 current sector leaders by a pretty sizable amount too. The next that we have is staples at 12. So that is a second point of confirmation here. First, historical trends have been very positive. That's just math. But 2, right now, using today's relative strengths, we find that the exact 4 sectors that have historically been the leaders throughout November are our current leaders right now. If that's not enough reason for why you should care, let's go through a few more reasons. October, as I just mentioned, saw a potential turning point for the market, with the majority of sectors, except for communications, returning solid positive gains and showing some signs of recovery. Is October the bear killer that we hoped it would be? The second half of October sure looked like it. While it's way too early to tell, because you never know that you're in a bear market until you're in one, and you never know you're in a bull market until you're actually in one, it's definitely steps in the right direction. Additionally, November has historically been a strong month for the market overall, especially in the four sectors that we just mentioned, being energy, industrials, financials, and materials. Not only that, the sectors that have historically performed well are the current sector leaders, as is shown by our relative strength data. Now, that's the good side. Let's also add the why you should be cautious about November. Midterm elections add a large deal of uncertainty. That goes without saying. So when there is uncertainty in the economy, in the market, or in US politics, there only becomes one certainty: uncertainty. And while you and me might not like the uncertainty of not knowing where things are headed, the market doesn't like it anymore. So as we move through November, it's going to be very important to see what happens next week. The trajectory that we find in the third week of November, that down week, is going to be the test of, do we see new lows and a regression back into a full bear market, or do we see this recovery trend continue? Again, if we see a large loss or a moderate loss the third week, that's not surprising. That is expected based on historical probabilities. But what is really going to be telling is the second half of November, where things go after that, going in through Thanksgiving and entering into December. Then we can start blasting the Mariah Carey, all right? General rule of thumb, you wait till December 1st to start blasting Christmas music. But that's a topic for next month. The topic for today is done. We've covered how the market changed in October, how the major events that we've discussed in the previous monthly forecast shaped out, and we've talked about where things might be headed and the key dates that will shape the market this month are going to be. So, if you have any questions or have additional ideas or want to have a conversation about this, chat is always a great place to have a conversation. Ask your questions and have a conversation with other Sectors Made Simple fans. You can also email us at support@sectorsmadesimple.com with your questions or ideas for future webinars. Next week, we will be back to review Q3 earnings results and look at it all a little bit more completely. Again, all the data I was showing today was based on the first half of S&P 500 earnings. After this next week, we'll have over 80%. So we'll be able to have this conversation in a little bit more detail and a lot more clarity. So if earnings are interesting to you and you want someone to help you explore the numbers and explain why you should care about them, stay tuned. Join us next week. We're here every Friday, 4 p.m. Pacific, 7 p.m. Eastern Time. And it's great to see you all. Thank you so much for being here, and we hope to see you all back very, very soon. Have a great weekend, everyone.